Hello, I'm Mark Boyer, and this is Jason Jacoby with Boyer Financial Services, and welcome to the closing bell for this March the 24th. Ready for a weekend? It's been a
I'm
crazy week of markets again.
I'm ready. I'm ready. And obviously March Madness is here. It's been here, and UCLA lost last night, right? So
Yeah,
that's always a good thing for SC fans.
yeah. I'm winning in my bracket, so I'm a happy camper at the moment. I'm doing pretty well. Well, last weekend, you probably heard the news. This whole banking issue the last couple of weeks has been top of news stories, right? So we're monitoring all those. And then last weekend we had Credit Suisse that got bought by UBS for 3.2 billion, which was quite a sell price for UBS to pick up
Steal.
a bank that's been around for so long at that price. Some say it's like they bought it for the price of the building, right? It's an expensive building, 3.2 billion, but it still tells you kind of where things were with that bank and kind of the help that they needed. And it
Yeah.
reminds me a lot of 1998 when you saw a lot of banks kind of peers coming in to help the government kind of reduce the contagion and actually a lot of consolidation that happens. And so we're seeing that happening with these banks right now. It's really interesting. So that'll probably continue.
Yeah.
We see that. So, and then now today the news was the German bank, right?
Yeah. Deutsche Bank.
Deutsche Bank.
Deutsche. Unfortunately, Deutsche Bank, share prices at the time of recording, it was down about 5-6% right now, but it touched down 15% as of this early morning and on the European stock exchanges as well. Obviously, like Mark was just saying, the Credit Suisse kind of fallout from this week kind of had spread outside the regional bank picture of the United States, started affecting European banks or large multinational banks that throughout Europe that might have not been hit before, but now people are kind of in this sell first, ask questions later mentality, and now just with credit default swaps, which basically measure are basically insuring the investor against default by that
Yeah.
bank, skyrocketed, highest since the pandemic, highest
Yeah.
level since the pandemic.
Yeah.
So
So that's concerning, right? So that just means
absolutely.
that there's a lot of fear still out there in the markets, and that's kind of the thing that you hope, especially with runs on bank. It's all
Yeah.
about fear and emotion, and we talk a lot about this with you all in regards to emotion. I mean, times like this, you can get really nervous and allow the emotion to kind of take control. And in some cases, it's rightfully warranted. Other times, it can really cause you to make bad decisions. So, like on that example today is down 15%. Markets actually the stock has recovered, and so a lot of people jumped in and bought when everybody else was panicking, selling. So, no, yeah, it's just interesting to watch how it plays out. And so we're going to see a lot of that here in the next few weeks. It looks like so.
Yeah, and,
Until it
and
calms
just
down.
just to piggyback off of that is, the European Central Bank, there's no way they're going to let Deutsche Bank fail,
No.
just with how big their footprint is in the economy, and not only Germany, but Europe as a whole. Even outside of Europe, it's just not, they're not going to let that fail. So, take heed at this point. It's scary. I know as uncertainty is kind of unfolding and is here, but at this point, again, kind of contagion should be pretty contained moving
Yeah,
forward.
yeah.
But
So again, we're talking a lot about banks right now. It's interesting. Like again, 2 weeks ago we said this before. It's like banks weren't even in the picture,
Yeah.
and then that's part of like what was in the picture was Fed raising interest rates very aggressively, and we thought they were going to even this week raise them 50 basis points, which they ended up only going up 25 basis points. And like we said last week, we think a lot of that. The bank issue has sort of done a lot of the Fed's job.
Yeah.
Banks are kind of the electricity of the economy. And really, that
True.
if the electricity goes out, lots of things can go out. And so, again, we don't think it's going out. It's scary enough to where everybody's going to rein in. Like I heard one person say, drop your pencils if you're a bank, bank manager, right? You're just like, they're not going to be loaning money out. It's not going to be as easy as it's been the last few years. So we'll see how that plays out, and that's probably going to help slow the economy, and that's what's going on. And the Fed actually, just raised rates this
Yeah.
week, and so going forward, the thinking is, we're going to keep, Powell said he's going to keep watching it. And see, how it plays out. I mean, I think the market's thinking maybe one more upwards 25 basis points, and then I'm hearing a lot of people talk about cuts now going into the end of the year. But that came after news on the housing market, right?
Yep,
So we had our
absolutely.
first time in 1 year the housing It rose
home
actually
price.
14.5% in February, which was still down 22.6 from the year earlier, but the first time in 1 month that actually
Had a little uptick.
prices went up. A little uptick, yeah.
Yeah, absolutely. And the median home prices, though, which is quite interesting too, obviously fell, maybe contributed to the fact that, if you had cash or you were looking to buy and rates had come down a little bit from the highs of 7%, might have spurred new purchasers or investors, homeowners to buy this
Jump
last
in.
month.
Yeah.
To jump in. So
Yeah, got to move quick.
we saw the increase in sales, but the median home price for the United States actually fell for the first time year over year in over a decade. So it's quite interesting, your pen drop comment, or your pencil drop comment. I mean, if you look at just how everything's tied together, the Fed and interest rates, the banking system, the banks maybe not willing to loan out as much money right now, especially the regional banks, which a lot of the construction companies, the contractors, even homeowners, they all rely on these regional banks for their mortgage loan payments, or their mortgage loans, or loans for construction. So, it could spell a little bit more of a harder time period for real estate, but that's to be seen, right?
Yeah, that's what we don't know. So that's what the point is this is going to have to play itself out, and the Fed has to be super careful in not raising rates. I mean, it'll throw us, we already planning on at least a mild recession. The question is now, and what the markets are really struggling with is, if it's going to be a deeper than a mild recession, at this point. So again, key in our minds is to, stay diversified. We talked about the emotional part, keep the emotions out of it, and, keep your long-term perspective, but, there's just opportunities everywhere right now within the markets. We're finding opportunities in different places, a lot of financials, maybe not so much the banks, but the insurance companies and things,
Absolutely.
There's just always opportunities when markets drop. And so, so we need to stay diligent in watching for those opportunities.
Yeah, and speaking of opportunities, you and I have obviously talked a lot about just dividend payers, dividend growers, kind of our bread and butter, our core philosophy, and we've obviously built around that with growth companies, bonds, alternatives, whatever it may be, but just investing in high quality companies, strong balance sheets, cash flow healthy, even through hard times. That's kind of what we're looking at right now in times of uncertainty like we're all experiencing. It's always beneficial to your portfolio.
No question. Dividends are a huge part of it. It could be up to 70% of a stock market, stock's return is based on dividends. So we're always watching for those solid companies that have positive cash flow, low debt, and all these areas that can withstand.
Amen.
Right. And so I think even in the NASDAQ and some of the growth areas right now, you see the NASDAQ up this year, but a lot of that's into the large companies, the big ones. The Microsoft's been moving. You got AI out there. There's a lot of transformational type things that are happening that are very exciting. So in the meantime, as we're dealing with all these other issues, so always, a lot of things going on. There's a lot of news, and it can keep your mind going, berserk if you you let it flow too much. But our goal is to stay calm and give you a calm perspective and of what we think is happening, and as we move forward, we're confident we'll get through this period of time. We always have, and we know we will again.
Absolutely. Great wisdom here from the great and wise Mark Blair.
Just older. I'm not sure about wise. Although I do have gray hair. Supposedly, the Bible says it's a wise man. Listen to him.
There you go. You heard it here. Make sure you listen to him. But last thing we want to touch on before we let you go, I know it's a little bit longer, but lots to cover. Again, amidst uncertainty, we want to be the thought leaders and the educational instructors, per se, to kind of walk you through this interesting time. But durable goods orders for February, if you take January and February numbers together, down 5%, which could spell a negative GDP quarter for us here in quarter one of 2023. Again, to be seen, but usually could be a leading indicator here for a potential recession coming up here, hopefully a mild one like you had mentioned.
Yeah, for sure. So all right, well, thank you, Jason. It's good to be with you today, and you guys have a great weekend, and
see you next week.
See you next week.